Ever heard the phrase, the rich get richer? Well, when it comes to dividend investing, it's not just a saying, it's a reality. Once your portfolio hits that $100,000 mark, your income hits the multiplier effect. The money starts working smarter, not harder. Your dividends aren't just trickling in, they're doubling down, reinvesting themselves, and multiplying your returns. It looks almost unfair how quickly things can snowball from here. Your money's now in a self-feeding loop where every reinvested dividend buys more shares, which creates more dividends, and the cycle continues. And once it starts, it's tough to stop. But why does everything seem to explode after $100,000? Why is this number such a turning point for every portfolio? In this video, I'll walk you through exactly how to hit that $100,000 milestone using a real market stock. I'll show you why its return multiplies after reaching the first $100,000. I'll show you how to double your portfolio to the second $100,000 in just 3 years, and then add $100,000 every year after that. In the end, I'll show you how, in the long run, this snowball can reach a valuation of over $3 million. And all it takes is a one-time investment of $10,000 to get started. But first, let's set the stage. So why is that first $100,000 so important? Well, it comes down to two main factors. First, there's the challenge of building up your earning potential. Think of it like leveling up in a game. You need time and experience to increase your skills and income. Second, and perhaps more importantly, it's about understanding the power of compounding. You see, in the early stages, your money's like a small snowball. It takes time to grow. But once you hit that $100,000 mark, that snowball starts to gather speed and mass, picking up more and more as it rolls down the hill. This is when your investments start working for you in a way that feels almost magical. In simple terms, compounding is when your investment earnings generate their own earnings. When you first start investing, your returns might seem small and slow. You put in the effort, you see a little growth, but it can feel like you're just inching forward. That's because in the early stages, your investment base is relatively small. But as you keep contributing and reinvesting those dividends, your portfolio begins to grow, and the effects of compounding start to become more noticeable. Let's take a closer look at the numbers and see how this works. Let's say you're saving $10,000 annually and you're earning an 8% annual return. In the first year, that 8% return on your $10,000 amounts to $800. Not exactly a fortune, right? But remember, compounding is all about the long game. By the end of the second year, you're not just earning 8% on your initial $10,000, you're earning it on $20,800, your initial investment plus the first year's growth. That's $1,664 in the second year, a noticeable jump already. But here's where it gets exciting. By continuing to save $10,000 annually at an 8% return, you'll cross the $100,000 mark by the 8th year. At this point, your investment is now working for you, generating around $8,000 annually just from the returns alone. And the magic really starts to happen after that. Once you've hit $100,000, the snowball effect of compounding kicks in even more powerfully. As you can see, by the 9th year, your balance could be around $118,800 with $9,504 earned just from the returns that year. The returns start to compound themselves, and each $100,000 milestone is reached faster and faster. To give you a clear picture, if you continue with the same $10,000 annual contribution and 8% return, you'll hit $200,000 by around the 14th year. So while it took you 8 years to get the first $100,000, it only takes about 6 more years to reach the next $100,000. The third $100,000? Even quicker. It takes just 4 years. The acceleration is the beauty of compounding in action. This is why reaching $100,000 is such a pivotal moment. It's like hitting the gas pedal on your financial journey. The growth from compounding starts to become more significant and your portfolio begins to snowball in a way that feels almost effortless. By the end, I'll show you a stock that with a one-time investment of $10,000 takes 12 years to reach its first $100,000, adds another $100,000 in just 3 years, and then continues to grow by $100,000 each year after that. And I'll show you how in the long run, this snowball can reach a valuation of over $3 million. But there's more to it than just numbers. There's a psychological shift that happens too. Once you hit $100,000, your mindset shifts. You start to see the potential for even greater growth. You realize that the habits and strategies that got you to $100,000 can take you even further. Crossing the $100,000 threshold has a way of changing your relationship with money. You become more focused on the long term. Instead of getting caught up in short-term fluctuations, you start to see the bigger picture. You understand that building wealth is a marathon, not a sprint, and this mindset is crucial because it helps you stay the course even when the market gets rocky. But here's where things get really interesting. Once you've crossed that $100,000 line, the strategies that helped you get there start to work even more effectively. And one of the most powerful tools in your arsenal is dividend reinvestment. Dividend reinvestment is one of the simplest yet most powerful strategies you can use to grow your wealth. It's the process of taking the dividends you earn from your investments and reinvesting them back into the same stock or fund. This might sound straightforward, but the impact it can have on your portfolio's growth is anything but ordinary. When you reinvest your dividends, you're essentially buying more shares of the company or fund that's paying you. And as you buy more shares, your future dividend payouts increase, which allows you to buy even more shares. This creates a self-reinforcing cycle that can lead to exponential growth. Let's say you've reached the $100,000 mark and you're earning dividends at a 3% yield. That's $3,000 in dividends in the first year. Instead of spending that $3,000, you reinvest it, buying more shares. The next year, your dividend income isn't just based on your initial $100,000, it's based on your $103,000. This means your dividend income grows year after year, and the more you reinvest, the faster it grows. It accelerates the compounding process, allowing your portfolio to grow at a faster rate than it would if you were simply relying on capital appreciation. And the best part, this growth happens automatically with very little effort on your part. But reinvestment isn't just the only factor that contributes to the explosion of your dividend income after $100,000. There's also the matter of diversification. Diversification is a key principle of investing, and it becomes even more important as your portfolio grows. When you're just starting out, you might be focused on a few core investments, but once you hit $100,000, you have more flexibility to explore different sectors, industries, and asset classes. This not only reduces your risk, but also opens up new opportunities for growth. After reaching $100,000, you might start looking at dividend-paying stocks in different industries or even different countries. You might also consider adding other income-generating assets to your portfolio, such as real estate investment trusts. But diversification isn't just about adding new assets, it's also about optimizing the balance of your portfolio. This might mean shifting some of your investments into higher-yielding assets or reducing your exposure to riskier investments. And here's where the snowball effect really starts to kick in. Remember, in the end, I'll show you a stock that uses all these strategies to reach the $100,000 mark in 12 years, adds another $100,000 in just 3 years, and then continues to grow by $100,000 each year after that until it hits a $3 million valuation. So the snowball effect is all about compounding, earning returns on your returns. As your portfolio grows, the dividends you earn increase, and when you reinvest those dividends, you're buying more shares, which in turn generate even more dividends. The cycle continues, and over time, the growth of your portfolio accelerates. But here's the thing, this acceleration isn't linear, it's exponential. In the early stages, your portfolio might grow slowly, but as the years go by, the growth becomes more and more pronounced. This is why your dividend income can explode after $100,000. The bigger your portfolio gets, the more powerful the compounding effect becomes. There's a company that has this exponential growth opportunity for you, the United Health Group. Let's say you start with $10,000 today and invest it in United Health Group with a current dividend yield of 1.32% and a dividend growth rate of 20.34%. If you reinvested all your dividends, here's how your portfolio might grow over time. In the first year, your dividend income will be around $132. But as you reinvest those dividends and benefit from capital appreciation, your portfolio begins to grow. Let's fast forward to the point where your investment hits the $100,000 mark. This could happen around the 12th year if you're consistently adding to your investment and benefiting from capital appreciation. At this point, your portfolio is generating a dividend income of about $1,114 annually. It's significant progress from $132, but here's where things get really interesting. Once you cross that $100,000 threshold, the compounding effect becomes much more powerful. By the 20th year, your portfolio could grow to an impressive $575,463 with a dividend income of $5,218. The leap from $100,000 to $575,000 happens much faster than the climb to the initial $100,000. Why? Because at this stage, your portfolio's growth is fueled by both the reinvested dividends and the capital appreciation. The snowball has gained so much momentum that it's picking up speed on its own. And it doesn't stop there. By the 30th year, your portfolio could be worth over $4 million, generating a dividend income of $35,696 per year. Think about that for a second. What started as a $10,000 investment has grown into a portfolio that's not only massive, but also throwing off significant income year after year. This is the power of compounding at work. The longer you stay invested, the more your portfolio grows, and the faster that growth accelerates. But to reach and surpass the $100,000 mark, you need to have a solid plan in place. To reach $100,000 quickly, you need to know which companies are increasing their dividends. Click the video on the screen to see 9 dividend increases you need to know about.